Well, good afternoon, everybody. Welcome to Selecting an Option Strategy. I'm Connie Hill. We get together every week on a new day, Thursday instead of Tuesday, but at the same time, just as the market is wrapping things up. Happy that you would join me here today. Some of you have made a request, and that request has been, could we maybe talk about some of the other option strategies that maybe aren't the bread and butter strategies that we could go into a little bit today? And so I'm going to honor that request, share some information with you, and hopefully this will be fun. Of course, I think it's all fun. Anyway, all right, I hope you're following me on X. I'm Connie Hill, CS. I have the pleasure of having Cameron May in the chat. He is Cameron May, CS, and we'll post educational content throughout the day, and would love to interact with you. Cameron's here to maybe catch some questions that I can't quite get to, but let us know, okay? I'll keep my eye on the chat here as well. Let's go through our disclosures and lay out our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about is for informational and educational purposes only. Don't consider it a recommendation. We will be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. Multi-leg option strategies will involve multiple transaction costs. Past performance of any security or strategy does not guarantee future results or success. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That's something that's a little bit different in the paper money than in your live account. Paper money won't assign you early, and so you might get a false sense of security. In reality, it can and does happen. Okay, so we want you to be aware of that little difference. All right, going to give you a shout out for some upcoming workshops and market drive events. So look at these nice warm locations, you guys. Anaheim in November, Houston in December, Miami right before Christmas. Who does not need to go to Miami right before Christmas? Yeah, you might be living in Buffalo and you have awful snowy winters and you need a little sunshine. In any case, if you can get there, you'll enjoy it. It's free. It's only available to Schwab clients. They fill up really quickly. So if you think you want to go, just sign up for it. You can always cancel it later if you need to. Now, we always take a look at market conditions. We're going to talk about maybe what option strategies might be working for you right now. And I'm going to have you answer that in the chat, okay? What strategies are you find are working for you right now? Okay, we're always going to look at some examples on the platform, and then we're going to go into a new strategy today that some of you have requested that we do. So let's go see what's going on out in the market right now. Bring up my Thinkorswim platform. It did not come up. Let's try this one more time. There we go. Right there. All right. The market's closed. Did we end up down today? Let's see. Looks like we did. Looks like the markets, they rallied initially a little bit earlier today, and then they just kind of keep selling off a little bit. I don't know if it's the overhang of maybe what some of the Fed judges said today, or if it's, or in the 9th day of the government shutdown situation. But, it's not too harsh. Market put in another all-new high again today. All right, so it's been doing that very frequently. So this blue line is a 10-period moving average. It's an exponential moving average. This red line's a 30 moving average. And you can see, the market has been sticking really, a lot of the time above that 10-period moving average. Once in a while it comes down to the 30, but has been very bullish. And so as far as strategies go, there could be a mix of strategies that might be working for you, although I'd imagine most of them are more bullish type strategies. So John's got covered calls working for you pretty good. Deegan saying verticals, synthetics, and leaps, something longer term. Okay, excellent. Debit and credit spreads, says Tom, long calls and puts. So a variety of things you're having success with. That is great. Ricebird, I always lean toward a short put vertical, which, sometimes you will develop those strategies that you're really comfortable with. You're like, I know them. I do good at them. it fits my resources of time and how much time I can allocate to the markets and whatever. And they might be your go-to strategies. So RiceBird sounds like that is the case for you, and also maybe doing some long call verticals. Okay. Cash secured puts is what Hope is typing in there. So, you know, in a bullish market, you could have success with a lot of different strategies. Okay, let's see what the Nasdaq ended up like. It was a little bit stronger, I think, than the SPX was. Let's see if that's true. Yeah, it ended down about 0.15%, which is not too bad. Looks like it was down a little bit earlier, and then it pushed itself back up. So overall, red candle because it closed lower than where it opened. But this long shadow lets us know, yeah, the bears pushed it down to some point in the day, and the bulls pushed it right back up. And yesterday made a new high. Didn't do it today, but yes, it was pretty close to what it was yesterday as well. We look at the volatility index, it's still in those lower ranges, right? You can see it's just been kind of maybe hovering here between, let's say, 17 and change, or maybe like 14 and change. It's a really narrow area, so volatility hasn't been extreme. So that would mean a couple of things. Maybe not as much fearfulness in the market, maybe not lots of long put buying because people aren't quite so fearful. Okay. And it also means option premiums might not be as juicy all around. When implied volatility sneaks up on us, then typically we're going to find that some of the options get a little juicier, which is nice for a seller and a little bit more difficult for a buyer of an option. Let's head back here for just a moment to some of the strategies and talk through this a little bit. So some of the strategies you guys are having success with, I heard long call, cash secured puts, some long verticals, some short verticals. I think somebody even mentioned maybe a diagonal in here now and again. And then a synthetic stock would be if you are really bullish, right? Because you would be selling the put, buying a call, where both those legs hopefully create a dynamic for you where you're getting a delta of 1. And so you're seeing a lot of leverage working on a trade on that synthetic stock position. We haven't had a lot of opportunities for our bearish hats. We just really haven't seen them. We want to overall be trading the way that the market is going. And so that's why we've primarily done a lot of bullish strategies. Now, the one that we're going to do here today, it's actually not listed here. We're going to, it sort of is listed, a calendar spread. We're going to, and we've done some calendars in the past. Today, we're going to do a double calendar spread. And I'm going to teach you some specific rules to help you find a way of creating a process for yourself, creating a sample or an investing plan that you can follow, where you have kind of some rules and regulations to help you lay out maybe an approach to a double calendar. It's not the only way these can be traded. The things that we're going to talk about, there is a myriad of ways that different strategies can be approached. So this one is specific to an earnings play, because guess what's up around the corner? Earnings, right? Earnings are up around the corner here. Lola says long stocks and credit spreads have been good for you. Fantastic. I love it when you guys kind of find your little spot that seems to be working for you. That's fantastic. Let's get rid of the yellow lines. And what we're going to do, I do want to do a little bit of management with you, following up on a couple of trades before we get into that double calendar strategy. So let's head over here and get rid of that giant pencil. And let's go back here maybe to the SPX. I'm going to go to our monitor tab. And we've got a couple of things going on. Let's see, that was the trade went in on October 1st, which was last Wednesday. We had met on Tuesday, but the market was closed, so our orders didn't go in until Wednesday. Okay, we did a couple here. We did actually, we did 3 trades. We did this trade on GE. It is a short put vertical, brought in a credit of 350. We're up on the trade a little bit because there's been a little bit of time decay, but it really has quite a long ways for it to continue to work. It's going to be a trade of patience for us to let that time decay kick in. We're short the 290 put. And if we just look at the chart here real quick, kind of zoom in here. This is where we ended up getting in, and the stock just really hasn't moved around a whole lot. Okay, it's well above its short strike price. Okay, it's sitting there at I think it was 290, 280, and so it's well above that area. So we're just going to be patient. We're just going to let it work. LRCX. Last week we talked about 2 different trades, and we put on 2 different trades. Let me maybe make this a little bit. Let's just go to a 3-month chart here, so we can kind of drill in, see what things look like. So here we were sitting Tuesday, and the stock looked like maybe it was trying to bounce off this 10-period moving average. Kind of the body of the candle overshadowed the previous day candle, although it's not like it's a giant engulfing candle, but it's just nice to see, okay, the price action, it overcame what it was the previous day when it was negative. So we got into the trade the next morning. Okay, market opened up down here. So we had the luxury. They had some interesting news that came out with some of the semiconductors. These guys were a beneficiary of that. Huge day up here. So we got this big long ride on the candle that day. And then the next day, on one of our trades, which was a long call vertical, it hit our target where we said, if we can get out with 70%, we're going to be happy. Okay. Next day, it hit it. Awesome. We love that, right? We've got our order in there sitting there that says, if you get a chunk, just take us out of the trade. All right. And you can see what's happened since then. It's kind of run up a little bit higher next couple of days, and then it's kind of pulled back here. And so the other trade we had on there was a short put vertical. Okay. 121.25. It has more time on it, November 21. So it's still got like 43 days before it will expire. So again, it's sitting in a decent place, but it's going to take time for some value to erode. Now, I want to explore something with you here, and that is, what if we had, on the same day we got out on our long call vertical, what if we had gotten out maybe at the same time or the same day? What would things have looked like? Well, I happened to take a little snapshot of the picture before we got out of the long call vertical. So let me pull it up for you. We'll take a look. Tried to make it big so you can see it here. Okay, so this was our call spread here, 134, 132. It was a shorter time frame as well. It was October 17. But what I wanted to show you here is on that day when I took this snapshot, which was right before we exited the long call vertical, we had 150 credit that we sold. Okay, that we received Wednesday morning when we got into the trade. And by Thursday, with that big long move that it had the very first day in the trade and the next day, really the value of that spread was almost 50%. Okay, 50% would have meant that this was down to, say, 75 cents, and it was at 85 cents. So in a couple of days, we could have captured maybe 45-ish%, maybe 47% of that 150 credit. Now, could somebody have felt really good about saying, I'm just going to get out now? I'm just going to get out now. I like being up on the trade. Yeah, you certainly couldn't fault anybody if they wanted to do that, because you're in the trade for 2 days and you get almost half of what you thought you were going to get waiting for 50 days. Okay, so I happened to take a snapshot there, and I thought, we're just going to kind of watch it, see what things look like going down the line. I did not close the trade out. The trade is still sitting there. Okay, so we still have this. And let's see how much it's worth now that the stock's run up and pulled back. All right. This might be disappointing, but on it, we brought in the $1.50, but the value of that spread right now is 108. So it hasn't decayed as much as it had by the time we had been in the trade for 2 days, and it just made that really sharp, big move for us. Okay. Now we're not in bad shape at all. We're just going to be patient and let it work. But when you're kind of thinking through, where might I want to get out early? Where might I want to maybe be happy to bank some unrealized profits? Then some of those thoughts you can start thinking about and thinking, is it worth it to me to maybe exit the trade early so that I can do that? Okay. So that's what I wanted to do there. Let's see. All right. You guys are just having some friendly banter with each other, which is great. All right. Let's move on. We're going to let both of these trades still work. They're marinating. We're just going to let them do their thing. All right. Let's head over to here. And we're going to look at a stock that has earnings coming up next week. Okay, that's when we're going to be starting to get a bunch. I think we had Delta Airlines today. The stock we're going to look at is United Airlines. Okay. And they announce on Wednesday after the market closes. That's just kind of showing the details on my line there. There we go. There's the earnings on the 15th after the market closes. So that's next Wednesday. And so what we're going to do is we're going to try to position ourselves in this trade. You don't have to get in as early as we are. I was just trying to find a stock that really met what I might want to consider using a double calendar strategy. Okay, so I maybe should write a few notes out here in our scratch pad. So let me maybe delete kind of like that information there. And I'm going to just kind of type out a couple of things, and maybe I'll do it up a little bit higher, because I know sometimes that photo gets in that corner, and then you're going to go, Connie, I can't see it. Okay, so I'll start doing it up here. With this particular approach, with the rules that we're going to lay out here, big cap, large cap stocks that have lots of liquidity typically are going to be the ones that you might want to target here, as opposed to small cap stocks. Maybe don't have weeklies, maybe don't have a lot of trading activity. We really want lots of trading activity. So you could put a threshold there. You could say, looking for large cap ones, but maybe also those that trade, at least a couple of million every day on average. Okay, so you get an idea. Yeah, we're looking for those that are having a lot of trading activity. Okay, so I'm just going to put the stock here. I'm going to say typically we'll look for something over $40. When it's a little bit lower price than that, it's kind of like you don't have enough range to work with to put together a call calendar and a put calendar. Okay, so if we have something that maybe is a little bit more expensive, so United Airlines is a $100 stock, so it kind of fits that bill. And then I'm also going to say here larger cap. They don't have to be mammoths. Okay, you don't have to stick with the 10 biggest market cap stocks that there are out there, although kind of stocks that are in that arena might be good. All right, next up, larger cap stocks. All right. Next up, we want there to be a lot of implied volatility priced into the options that expire the week they announce. That's at least 10% higher than what the week is that we sell or what the month is that we sell. Okay, so I'm going to kind of write that in here. And so I'm going to say plus 10% vol front week/month over the long leg. All right, leg just has one G. All right, so let's go to the trade tab here. And let's see what we have. So knowing that they're going to announce their earnings on the 15th, that means the options where they expire are going to be these ones, the October 17th. Come over here to the right, we can see implied volatility here priced into the at-the-money options at about 70%. And so then our leg that we're going to buy, we're actually just going to buy the next week out. We want it to be at least 10% higher than the week we're going to buy. So we could have got away with 60% here, but it's more like 58%. So it's about 12% higher. So you're like, okay, it checks the box if that's something that we're looking for. Again, this is not the only way to trade this strategy. Okay. You want me to go back to something for a moment, Jayton? We're going to continue through with the trade, but if you tell me what you want to look for, then I can take a break and show you. Okay. All right. Next up, let's identify the move that the market has priced into the options. Now, we have what's called the market maker move. Some of you are familiar with it. If that calculation has been done, usually it kind of sits about right here. I think it kind of sits right there, and it's yellow. And it has this little icon that is 2 M's on top and a 1 M below for the market maker move. However, it's in a font that to me, it doesn't really look like M's. To me, it looks like free weights. Okay. But that's the spot that it sits. Now, it doesn't have to be for earnings when they create this market maker move. It could be for big announcements, big product announcements, maybe FDA announcements on a drug that maybe is in trials. Okay, so some sort of big news, then they'll tell us, what the expected move is. Well, if nothing is sitting here, we're going to calculate it ourselves. Okay, way we calculate it ourselves is we're going to do the straddle. Okay, so we're going to open up the October 17 options here. All right, and stock closed at 101. We actually have $1 increment price strike increments, which is nice. So we can find 101. And so our at the money straddle is going to be the sum of 445 plus 395. So let me grab our little calculator we're going to use here today. And don't want it in the way exactly. So we're going to go 4.45. So the ask price plus the ask price on the put side of things, which is 3.95. And that gives us a value of 840. So the price that the market makers have priced into the move for that week, those options, is about $8.40. And so if the market maker move was sitting up here, it would probably reflect something close to this price. Okay, about 840. But that gives us an idea, well, how big of a move should we be identifying? Okay, so if I'm going to just round that down to 8 instead of doing 840, we'll just go with $8. Okay, so $8 up, $8 down. So if the price of the stock closed at 101 plus $8, that's going to put it at 109. Okay, so I'm just going to kind of type that in over here. And the 109 strike is what we're going to look for our call calendar. Okay, we can see out here, it does nicely meet up with that number because of the single strike increments. Okay, and so 109. If we were to sell that particular one, we're going to have to be using the bid price here. Okay, this would be kind of like the premium that we would bring in. And so I'm going to write over here on the side $1.46. Okay, and we're going to, well, I've already written down 109. Okay, if we take $101 and we subtract 8 from it, what's 8, right? then we're going to be looking at 101 to what? That's going to be 92. Make sure it's the same one that I was looking at previously. I was looking at maybe 91. But 101 minus 8, it's going to be 93, isn't it? It's going to be 93. Okay. If I'm wrong, you guys tell me, okay? But I think that's right. And so if we're going to be selling this front week option, what we're going to get out of it is going to be in the neighborhood of about 106. Now, very well, we could get filled at the midpoint price here, okay? But for calculation purposes, we're just going to go with whatever the flat number is here. So we're going to say 1.06. And what I'm going to do is I'm going to add those two values together, because that's going to be the value of our front week credit, and would like it to be decent. Okay, I'll tell you what decent means. Let's see, Jane, let's see. Jane, we're not going to go into the details of the columns actually out on the monitor tab. These are columns that James Boyd, there's some James Boyd scripts that he uses a lot in his classes. And so they're just kind of informational here. They're not going to really be used right now in making decisions, okay, on those two positions. I think that's where you were going back to, okay. Information, it's useful, great. All right. Oh, no, we want the trade tab, not the chart. Okay, so this represents the 146 and 106. 146 plus 106, and I need to stick a decimal in there, is $2.52. This is going to represent the front month, in this case, week premium, okay? And I'm just going to call it the front week, okay? Well, we've got our strike prices picked out. We're doing 109, and what did we end up with? 90, let's see. 106 was the 93. Okay, so that's going to be on the put side. This is going to be on the call side. All right, is everybody with me so far? I hope so. I'm going to tell you this particular session is a little heavy on the math. Okay, if you don't like math, just follow along anyway. All right, so let's go see what is it going to cost us for our long leg that we want to buy for the other half of the calendar. Okay, so we're going to just use the next one out. So we're going to use these, the October 24s that have 15 days to expiration. And one of the reasons you want good liquidity in the options is because we want there to be other contracts trading hands. We want there to be things going on so we can get into and out of the contracts fairly easily. And so by kind of looking for those larger cap stocks, looking for the higher volume. Okay, today this was 8 million in stock volume. That kind of helps guide us to the right kind of strike prices. Now, if, say, we pulled up this next week and it did not have enough open interest, you might have to go out a little bit further to find one that maybe did. Okay, we're okay with this one. So we said here we're going to do 109. Let's scroll down here a little bit. And so on this one, we're going to be buying the 109. So we're going to be paying $213 for it. And then on the 93, we're going to be buying it. And so that's going to be $1.62. And what I'm going to do is I'm just going to see what the total of those are. And I'll show you why here in just a minute. Grab that calculator back. So we've got 213 plus 162 is 375. That's not bad. That's pretty good. What we're looking for is we would love for the front week to pay a good chunk of the long legs here. Okay. Because when the news comes out, whatever that news is that we're expecting, implied volatility is going to come crushing out. And so we're wanting this to be a little bit juicy and help basically pay for the longer legs out here. Okay, so that's what we're looking at here. Okay, so let's go ahead. Let's construct the trade. As you have questions, go ahead and chat those in. I think I'm trying to keep track of them. Cameron's keeping his eye out there as well. Okay, so let's go put it together. And we're going to start with our 17s. And we're going to come out here. We're going to start at our 109 strike price. Right mouse click. We're going to be buying. You're going to come over here where it says double diagonal because it doesn't have a separate one for double calendar. Okay. So you have to go to double diagonal and then choose double calendar. Now, it knows what we want for the call spread because we started there at that 109 strike. It really doesn't know what we want on the put spread. Okay, so we're just going to change this. So we're going to change this 109 to 93. Roller bar was a little bit quick. And then 93. Okay, so our net debit on this is 109. Okay, so that collecting the 252 of premium in that front month really helps really lower the net debit on this. Now let's take this over to the Analyze tab because we kind of want to visually take a look here. Let's see here. I'm going to make sure. Oh, okay, that's why it's goofy. It's got this one stuck in there. All right. I wonder it wasn't spreading out the way that I wanted it to. Ooh, this is looking good. We're getting the Batman look. You know, the double cat ears. And so we want the date here. This is actually today's date that is showing. We want to put it to the furthest out date, okay, which is going to be for the 24th. So that's the date we're going to put here. Usually if we're doing verticals, they're the same date, right? This one, we've got those two different dates, same strike price. Oh, we're going to do it in October. So we're going to go October 25th here. Okay, let's go ahead and let's get today here. It's the 8th. We really want it to be the 9th, so it's showing us right now. Now, where's our peak profitability going to be here? Okay, at options expiration. Okay, so it's going to be wherever these peaks are. Okay, so one peak profit area is going to be around 93. The other peak profit area, would you say 103? Yeah, hopefully you were saying, I know it's going to be, or 109. I said the wrong number. It's really 109, not 103. Yeah, those are going to be our peak profitability points. Now, come options expiration, can the stock be at both of those peaks? Yeah, it can't. It can't be both 109 and 93. It can't be in both those spots once it expires. Okay. For our purposes, we might favor that maybe it goes up to the 109 area because our peak profitability is a little bit higher. And so keep an eye down on these numbers here. So I'm going to try to get that right smack on 109. Now that's going to have to be close enough. So it looks like about 253.11 would be peak profitability on this trade if it expired right there. Okay. And then still decent profitability. Looks like that's about just shy of $200. It looks like maybe 197 is the peak price if the option expires or some options expiration day, the stock is sitting right there about 93. Okay, so both of those could put us in a possible profitable situation. Now, how many of you are getting better at using the risk profile tool here? Or some of you, I hope, getting more comfortable with it? It's a really a great tool for visual learners, okay? And to kind of see things, I think it's really helpful as trades progress to be able to put them back here in the risk profile as we start seeing the trade develop and time decay and price movement taking place. Okay. So down here, we can play with some of these variables. We're going to click on this gear. I hope you saw that. Maybe I should put a yellow square around it. Right here is this gear. You click on it and it opens up some more fields. And on those fields, we can adjust the volatility, which we already know from that peak week is about 12% higher than our long leg. Okay. We could come in here and we could say, okay, minus, let's go minus 10% here. Okay. We won't be really extreme. That's saying plus, I want a minus there. So minus 10%. If nothing else changed, but implied volatility dropped, that shifted things. Did you guys see that shift? And then as time goes on, we're going to experience some time decay. And so you can come out here, say you're looking at this trade, say on Monday. Monday's going to be the 13th. So it won't even be the options expiration yet. And it changes just a little bit. And as time decays, what we notice is our purple line, which is options expiration, and using this date out here, that's what our profit and loss scenario is, or theoretically is. Not cut in stone, not guaranteed, but you kind of get an idea of how the trade is evolving. And so if you're thinking, oh, the stock, it's moved up to about, say 106, 107, then you're thinking, okay, my profitability range maybe is going to be in this area, letting a little time decay. And with that movement, this purple line is going to adjust here as well. Okay, so those of you that are responding here, if you're using the risk profile, you're getting better with it. Great, Ricebird. Will's getting more comfortable with it. P.L. Anderson definitely benefiting from all using it often. That is great. That's fantastic. It's one of the nice tools that Thinkorswim has on it that you really don't find all the play everywhere, right? Okay, so what we're going to do is we're just going to watch this. Okay, we're going to watch it. And what are we going to do? We're going to, if we say implied volatility ramps up really big in that last month or the last week, our long week, if we're ahead in the trade by a certain percent that we're happy with, say we're up 30% or 40%, we haven't even gone through earnings, you might be satisfied to say, hey, I like this nice whatever that percent is. I think I'll keep it. I think I'll get out of the trade, or maybe reduce your contracts. Say you're doing 5 contracts. Maybe you say, well, let's take profits on 2 or 3 of those and maybe let the other 2 play through earnings or whatever, right? You could mix and match deciding what you might want to do. And there's no rule that says you have to get out, but if you see something that you're like happy about, yeah, you might decide to get out early. Our expectation is we're going to be listening for earnings. It's going to be after the market closes on the 15th. So if you're watching it that night, a lot of times we get a good indication if the market likes what they said, right? Because sometimes it'll move up or down in after market hours. And so we might get an idea of that, although it's not guaranteed. It's not going to be guaranteed to be there the next morning. It could trade totally different, but sometimes it gives us an idea of maybe what to expect the next day. And then, depending on which side, hopefully it makes a decent move to, okay, based on what's priced into that straddle, what we think the market maker move is. Hopefully it moves to one or the other, but it doesn't have to. So the worst things that can happen in this trade is that it way overshoots it and it goes clear beyond it. And then we're down here below our zero profitability, or it drops way down beyond it as well. Okay, because then we're totally missing out on those peak areas. And that's why it's really helpful to use that market maker move to say, what are they pricing in? Doesn't mean it's going to go there, but what are the market makers pricing into these options? Okay, if this is a strategy that's interesting to you, I would say do some paper trading on it. You could use this example in your paper trade, put it on just to learn from, not that you think, that you're going to learn everything about the strategy or using the risk profile tool all in just one trade, but just to get more comfortable with it, get an idea of how this strategy can work. I have seen situations where it has been at a profitability point even before the earnings come out. And, say in our example class trade or whatever, we've chosen to just get out of it early or just get out some of the contracts. All right. Let's see. Dragon Rider says, oh, yeah, if I get a 15% profit, we'll take out half of it. Yeah, that idea of kind of harvesting the gains when you can and while they're available, without necessarily totally getting out of the trade altogether. Okay. You guys had a couple of questions I want to answer here. One of the questions was, we had two of them, and one of you said, I think that you found the webcast you were looking for. But when you become a subscriber to our Trader Talks channel, it makes it really easy to find our content. So we're going to head over there to our Trader Talks channel. And I have selected here playlists. Now, somebody was looking for the trading index options class that we did yesterday. We talked about 0DTE options, followed the day in the life of an options contract that I tracked all day long. Okay. And we kind of went through that information. So that is where you can find it. So just go to the playlist, and it happens to be just on the second row, pretty quick and easy to find. Now, I think that may have been Deegan. Okay, now somebody else, I can't remember who it was, but early on, it was Lakshmi, was wondering, he said, you did a class a while ago about creating custom templates. Where is that class? So what you'd want to do, just come over here to the magnifying glass, right? That's our little search, and type in here, custom template, okay? Because that's really what was being demonstrated. So I've got two different videos you could refer to. Actually, Cameron has a couple, maybe has a couple there too. This is a custom scan, so maybe not. In any case, I created one of those mini videos to show you how you could create your own custom order template here. So just about 8 minutes, you can learn that. So you can find that there. Or a long time ago, you were thinking it was a while ago that I taught that class. This one's coming up here. It looks like it was streamed about a year ago, where I taught you that in a class as well. But it's the same thing that I'm teaching you here. It's just not a whole class on it. I just teach you kind of the process of how to create that for yourself. Okay, so if you're a subscriber, it makes it so much easier for you to find our content. I again invite you to follow Cameron and I in the Land of X, where we post educational content, things that you might be interested in. And if you found this helpful today, go ahead and hit the like button on the way out. I did not see a survey today, so you're off the hook for the survey. But if it was useful to you and you think others might enjoy listening, then go ahead and hit that thumbs up, because it helps in the algorithm so that they can find that content when they're searching for it. So you're doing a favor for somebody you probably have never even met before. All right. Cameron, thank you for your help on the chat. Hope we were able to answer all the questions you had along the way. If not, or other ones come up, go out to this recording, the archive of this class, once it gets posted, and go ahead and ask me the question there, right? Because we go back and look at those throughout the day and make sure you get your questions answered. Excellent. All right. Well, my time is up. This is the last class of the day. So bright and early in the morning, right at the opening bell, we're going to have our ETFs class, our Trader Talk with the emphasis on ETFs. It doesn't get posted after the show, so you want to be there live to catch the content. And we're merging some content into that class that we were doing in the Monday afternoon class for those of you that are really following along with that ETF information. Okay, have a great evening, everyone. We'll see you bright and early in the morning, right at the opening bell. Bye-bye.